Okay, the next topic is the role of property and infrastructure in client portfolios and portfolio management. And I'd like to call up the host for that, Julian from AMP Capital.
Okay, well, good morning, everyone. My name is Julian. I'm going to be talking to you for the next 15 minutes on the topic of infrastructure before we move into a panel discussion. I'm going to touch on the current environment. I'm going to share with you my thoughts on the role that infrastructure can play in a portfolio, and I'm also going to comment on a couple of topical issues that I think are fairly important. It'll come as no surprise when I say that investors are facing a challenging environment over the next few years. It's an environment that's likely to be characterised by continued high inflation, increasing interest rates, and reduced growth prospects. As we're all aware, the Ukraine-Russia conflict continues to drive strong inflationary pressures in economies that are still struggling to recover from the COVID pandemic. And recent economic outlooks suggest a high inflation and lower growth environment over the next few years. Governments have been responding to the high inflation levels that have been seen around the world by increasing interest rates to try and rein in demand and reduce inflation levels. This is likely to continue and cause further pain for consumers, albeit the good news at this stage anyway is that we don't think that interest rates will hit their historic heights. There's also an increased risk of recession in many countries. As you're all aware, markets have been volatile over the course of this year, and the outlook suggests that there could be continued volatility ahead. In terms of the role that infrastructure can play in a portfolio in this kind of environment, if you look back to past recessions and challenging periods in markets, many investors have traditionally looked to infrastructure for its defensive characteristics. This is primarily because, as providers of essential services, infrastructure businesses tend to generate cash flows that are less sensitive to economic conditions than those generated by more mainstream industrial assets. And this can allow infrastructure to deliver relatively consistent yields to investors. So to me, this suggests that infrastructure has an important role to play in a portfolio in the environment that we're facing in the medium term. However, importantly, and I'll touch on this a little bit further later, infrastructure is absolutely not a one-size-fits-all asset class. It actually comprises a very wide variety of assets which have different characteristics and different risk profiles. And the current environment could impact different types of infrastructure in different ways. In our view, traditional core infrastructure is likely to be more resilient in a low-growth, high-inflation environment than more risky core plus infrastructure assets. So what role can infrastructure play in a portfolio? Well, there's really three key things I'd like to point to. The first is that infrastructure has the ability to offer consistent returns with relatively low levels of volatility through market cycles. And that's because, as I alluded to a moment ago, infrastructure assets are essential services assets. And that means that they're assets that people have to use on a day in and day out basis. As an example, think of electricity distribution networks, which distribute energy to communities for lighting, for heating, for cooking and so on. And that's exactly what I mean by an essential service asset that we all need to use every single day. And it's due to the nature of those essential services that they provide that these types of assets are often less influenced by economic factors than many other businesses. In addition, infrastructure assets often enjoy the protection of monopolies or benefit from high barriers to entry in the markets in which they operate. And this means that they're often free from competitive pressures which are faced by many more traditional companies. Secondly, infrastructure can provide consistent long-term income yields. And that's because infrastructure asset revenues are often underpinned by regulation or by long-term contracts. And that provides a high level of certainty around the cash flows which infrastructure can generate for investors. In addition, infrastructure asset revenues are often linked to inflation, which can help investors protect against the erosion of their investment by inflation over time. And then a third and important benefit is diversification. Overall portfolio diversification is improved when all of your assets aren't doing the same thing at the same time, or, to use another term, have a low level of correlation. The infrastructure asset class has traditionally shown relatively low levels of correlation with many other asset classes, meaning that its inclusion in a portfolio is an effective means of helping to reduce your overall portfolio risk levels. I wanted to touch on inflation, which is clearly a very topical and important area for infrastructure and for many other reasons. There's actually no way I can really do this topic justice in the time available, but I'll make some overarching comments. I think before I do, though, it's really important to acknowledge that the performance of infrastructure assets can be impacted either positively or negatively by a range of economic factors, including things like inflation, interest rates, levels of economic activity and so on, and also by a range of other factors, which may include things such as operational matters within infrastructure assets. And the net impact on an infrastructure asset's performance and cash flows will actually depend on how all of these positive and negative impacts balance out. However, in terms of inflation, broadly speaking, many, although not all, infrastructure assets have their revenues linked to inflation. Now, this can occur in a variety of ways. As a guide, this could be, for example, through built-in inflation escalators under the concession or contractual arrangements that sit around an asset. It could be through the regulatory framework within which an asset operates, or it could even be as a result of an asset having pricing power through occupying a monopolistic position, which allows it to be able to pass through the impact of inflation to the end users of the services that the asset provides. The table on this slide contains a very general summary of our views on the potential impact of inflation on infrastructure, which I've classified into three subclasses for these purposes. However, again, I stress that the impact can vary by sector and by asset, and can also vary depending on the jurisdiction in which a particular asset is actually located. So the first category are growth-linked assets. Something like an airport is a good example of that. So if you think about, for example, Australian airports, typically Australian airports will have ASAs, aeronautical services agreements, in place with the airlines that use the airport, under which they're remunerated for providing their facilities to the airlines. Now, those ASAs will typically contain annual escalators. In addition, many airports have significant retail or property businesses, and the leases that relate to those operations will also typically contain annual escalators. Now, those escalators are sometimes linked to inflation, although sometimes they're linked to another factor, which can actually work for or against you depending on where you are in the cycle. So they're not always a perfect hedge to inflation, but they do provide at least some level of protection. And then in addition, in a growth asset like an airport, patronage tends to increase in a growth environment, which can also help offset the impact of inflation, although I do acknowledge that the growth outlook is somewhat more precarious at the current time. The second category of assets are regulated assets, so things like electricity transmission and distribution networks. These assets tend to be more yield than growth orientated, albeit they can benefit to some extent from economic growth, although to a lesser extent than the previous category of growth assets. Many regulatory frameworks around the world are structured in such a way that inflation is essentially passed through to the end users of the services. However, this can depend on the jurisdiction in which the asset's located. In some countries, examples include Australia, New Zealand, the UK, inflation is essentially almost automatically passed through to end users the way the regulatory framework works. But in other countries, such as the US, it isn't. So you need to be aware of the regulatory system in the jurisdiction in which you're investing to really understand whether or not inflation can be passed through to end users in regulated assets. And probably the other point there is that there can actually also be a timing lag on the passing through of the impact of inflation, depending on how the relevant regulatory system works. And then the third category is PPPs, or public-private partnerships, which are often social infrastructure assets like schools, hospitals and the like. These types of assets often, although not always, but often have fixed availability style revenues, and that provides a very high level of certainty and consistency around the cash flows that the asset will generate for its investors. However, on the flip side, unlike the growth assets that I referred to a moment ago, there's very limited scope to drive increases in revenue. For most PPPs, asset revenues are actually indexed to inflation. For many of them, they're 100% indexed to inflation, albeit there are some assets which are indexed by an amount other than 100%. So for these assets, it essentially means you've got a partial hedge to inflation, leaving some residual inflation risk. Something to be aware of is that what appears to be infrastructure on the surface may in fact not be investable infrastructure at all. When we're looking at infrastructure businesses, there are certain common characteristics that we look for. The asset needs to provide essential services, and that helps provide resilience through market cycles. It should be a natural monopoly or enjoy a very dominant market position. We look for consistent and predictable long-term cash flows with inflation linkage, and so on and so on. And pretty much every infrastructure manager could sort of reel that sort of stuff off for you. However, I think also conversely, it's important to be cognizant that infrastructure consists of a very broad range of assets, and some of those assets don't actually possess those kind of characteristics. And indeed, we would not consider them to be investable infrastructure. If you look at any of the broad-based infrastructure and utilities indices in the market, they all contain constituents which we would not consider to be infrastructure. Examples might be companies whose revenues are heavily influenced by commodity prices. It might include, for example, energy generators who sell their product into the market at spot market pricing. That's not the kind of consistent, reliable, long-term cash flow profile underpinned by a regulatory framework or a long-term offtake contract that we would typically look for in an infrastructure asset. We actually conducted a fairly interesting exercise several months ago where we reviewed one of the major global listed infrastructure and utilities indices, and what we actually found coming out of that review was that just over 26% of the constituents in that index didn't actually meet our definition of infrastructure. So not only that, but importantly also, infrastructure is a heterogeneous asset class. So-called similar assets, which might look the same on the surface, may in fact actually be subject to very different drivers of return and risk. And for that reason, we think that it's very important when you're investing in infrastructure to really understand each individual asset or company's specific underlying characteristics. If you think about the major east and west coast airports here in Australia, so Sydney, Brisbane, Melbourne, Perth, they're all airports, they're all in the same geography, but they're all actually subject to a range of different drivers of passenger volumes. If you think about Sydney and Melbourne airports, they're the primary gateways into Australia, and they tend to see the largest share of the international tourism market, such as it is at this point in time. Both Sydney and Melbourne have large migrant communities and also support large or host large populations of international students. And all of that drives the VFR, the visiting friends and relatives travel market. Sydney and Melbourne also have the most corporate headquarters in the country, which drives the corporate travel market. Obviously, you still see corporate travel in Perth and in Brisbane, but from a pure volume perspective, Sydney and Melbourne are the biggest markets. And also, New South Wales and Victoria have the largest populations, which can translate into higher levels of passenger movements. Perth Airport, really interesting, services a lot of mining-related FIFO traffic. WA actually has a huge number of small airports which are essentially feeding the mining and resources industries, and Perth Airport actually sits at the other end of the line for most of them. Brisbane Airport also sees FIFO traffic and also services a lot of leisure and tourism travel. One of the things that I thought was really interesting through the COVID pandemic, at a point where we obviously had the international border closures, but we also had a lot of domestic border closures, was that airports in geographically larger states, like WA, like Queensland, actually enjoyed the benefit of meaningful amounts of intrastate air traffic. Whereas in geographically smaller states, like Victoria, for example, this was nearly non-existent. So when it comes to considering things like diversification within an infrastructure portfolio, in my view, sort of the blunter top-down measures don't tend to work as well as they could, and you really need to understand the underlying characteristics of each asset to understand whether or not you actually have good diversification within your portfolio. I wanted to touch very briefly on renewables, and the reason I did was because I actually think it comes up in pretty much every conversation that I have about infrastructure. There's no doubt in my mind that decarbonisation will be one of the biggest trends that we'll see unfolding over the next few decades. After a patchy and inconsistent start, the energy transition is gaining speed globally. We're seeing world leaders and the private sector increasingly rallying in an effort to deliver the targets set out in the Paris Agreement on climate change. It's a really complex area, which sees the need to balance addressing imperatives such as climate change with the need to continue to provide energy security, and this against a backdrop of significantly disrupted world energy markets as a result of the Russia-Ukraine conflict. In principle, we really like the space, green energy, very much like it. We've looked at a considerable number of opportunities in the area. We've made a number of investments, but we've also walked away from a range of others. It is still an evolving area of the infrastructure market, and consequently we've been and continue to be selective about the opportunities we pursue in the space, largely for a couple of reasons. First is that for assets of this type, looking backwards, there has been at various points a lack of coherency or consistency in the regulatory environment within which assets like this operate in a number of jurisdictions, although we do expect this will continue to resolve over time. And secondly, is simply that there has actually been a significant weight of capital pursuing renewable opportunities, which has driven up pricing. And what we've actually seen as a consequence is a number of instances where we've seen renewables with a particular risk profile transacting at prices which are actually commensurate with the prices we've seen on other infrastructure opportunities which have a lower risk profile. Nevertheless, decarbonisation is a theme that we expect to see continuing to play out over the long term. It's an area that we're really excited about. It will require a huge level of infrastructure investment over the coming decades, and as that occurs, it's going to drive more and more infrastructure investment opportunities. So to wrap up, the global infrastructure investment environment continues to look challenging, the global investment environment continues to look challenging over the next few years. As I mentioned at the start, we expect inflation to remain elevated. We expect to see further interest rate increases, and we expect to see constrained economic growth and increased risk of recession. From an infrastructure opportunity perspective, we expect that there will be a strong medium-term pipeline of infrastructure opportunities as governments around the world roll out infrastructure developments as part of their post-COVID economic recovery plans, and that will likely translate into a range of investment opportunities for the private sector in the future. So while it's not immune to economic conditions, compared to many other asset classes, we do expect that infrastructure should be relatively resilient and hence popular with investors due to its ability to offer steady returns due to the essential nature of the essential services nature of the assets, which will underpin demand or usage, secure revenues and the inflation hedge that the infrastructure can offer, which will be attractive in the current environment, and also for its diversification benefits. So this does suggest to me that infrastructure has a very important role to play in a portfolio. Thank you.
Great, thank you, John. Can I just call up the panellists for property and infrastructure? So moderator Marius Wentzel from IMAP Capital, Trent Koch from First Sentier Investors, Chris McAlpine from Context. Thanks for making the trip over from Perth, Chris. And of course, the incomparable Tim Murphy from Morningstar.
And I'm sitting right next to him. This time. And I'm sitting right next to him. All right. Hi, everyone. What we really wanted to do is make sure that given that infrastructure is an asset class that isn't as well understood as some of the other mainstream ones, that the panelists in front of you are very experienced, knowledgeable folk. And we sort of listed all the key questions that we received from the market. And we're going to try and address them. And then obviously at the end, there'll be time for questions as well. So today's your time to make sure that as you leave the room, that you have a really clear understanding of what it is, what it's not, and how to use it in the portfolio. So I'll crack on. And the first question, and the reason I'm squinting is because I'm not used to the routinely coming into the city, so I left my glasses at home. So if I get the question wrong, forgive me. All right. So the first question, if I was an advisor or portfolio constructor, why should I consider infrastructure in my clients' portfolios? Trent, do you want to pick that one?
Thank you, and morning, everyone. Look, I think John just touched on a lot of these points, but we've been managing our portfolio. It's a global listed infrastructure portfolio for over 15 years now. And I think for the first 5-10 years, there was a lot of education as to what role can infrastructure play in a portfolio. And I think we, in some ways, are beyond that. But if I was to break it down and give you, I guess, 3 key reasons to think about it, it would be firstly the income. This is an asset class that will give your clients a reliable, stable yield of around about 4% per annum. And I can basically tell you what the return will be for the next 3-5 years for our portfolio. Second one would be growth, and I would describe it as structural growth. So structural growth is growth that's less dependent on the economic cycle. So we all know it's a very uncertain time right now. We're potentially heading into a recession, but again, the resilience of the earnings of these companies, either regulated or long-term contracts, means that you've got good visibility on the earnings. So income, growth, and then I think the third reason would be lower volatility. For many of our clients, we're almost like a defensive equity. If you look at the returns this year, global equity is down around 15%. Infrastructure is actually up. It's only up by about 1 or 2%, but it's that downside protection in more volatile markets that it's providing to clients. So If you remember anything today, income, growth, and lower volatility.
Great. Thank you, Trent. John, you mentioned in your presentation that not all, like in every asset class, not all assets are treated equally. So when you're looking at a strategy on an asset, how do you know it's an infrastructure asset in your opinion?
Yeah, sure. Well, it really comes down to the characteristics of the specific asset. I touched on a few of them in the presentation. So looking for things like providers of essential services. We're looking for assets that enjoy the protection of monopolies, high barriers to entry in the markets in which they operate. We're very focused on consistent, sustainable, long-term cash flows. Certainly in terms of our area of focus, we're focused on mature operational assets that are cash flow and high margin producers. We look to avoid things that for example, carry a lot of greenfield or development risk. Avoid things where the revenues are heavily linked to the commodity price cycle. Merchant power generators who take spot market pricing. So we tend to sort of really look at the characteristics of the asset rather than the sort of the top-down label, if you like. It's interesting, over the years we've been shown, and I'm sure the guys here have seen them as well, a considerable number of opportunities that have been pitched to us as infrastructure, which have included things like fish farms, fertiliser plants, greenhouses, holiday villages and the like. So there's been, over the years, many instances of the definition of infrastructure being stretched, but we always try and come back to looking at those underlying characteristics that we look for.
Which sort of links to what Trent was saying as well as to what you should be looking for. Chris, in terms of those characteristics, I mean, how does infrastructure specifically differ from other alternative asset classes in the characteristics, and why is that good relative to the others?
Yeah, sure. I guess I'd start by saying we don't really consider real assets part of the broader alternatives universe. We do consider it a separate asset class. I think we make that distinction because the first thing that we're looking for in alternatives is actually low to zero correlation with equities. That's our primary consideration when we think about alternatives. And to be clear, with listed property and infrastructure, you are not going to get that. So it's playing a slightly different role. And then in terms of other differences to alternatives, I suppose we'd say the world of alternatives is a very wide and weird world. You can do all sorts of different things that can be heavily dependent on structuring using derivatives or very high levels of gearing or very high levels of idiosyncratic skill-based type things. Whereas one of the benefits with real assets is that, I suppose from explaining it to clients' perspective and your own understanding, it's a lot more tangible than what you're getting from the alternatives universe. You know with property that roughly you want buildings that people want to work in, live in, or run a business out of, and you're going to get compensated with the rents paid for those buildings. With infrastructure, you understand at a high level that you are paying, or you're investing in something that is generally at the core end of the spectrum essential to the functioning of a community. So there's a very clear story there. And also, as Trent alluded to, you have sort of a better idea over the short-term horizon of what your yield is going to look like. So it's more predictable in that way than a lot of what the alternative universe is going to get you.
Thank you. Thanks, Chris. John, just coming back to you around diversification, because obviously to invest, if you're going the unlisted route, if you're going to invest in infrastructure assets, diversification plays a role. So how would you consider diversification in an infrastructure sense?
I think in any portfolio it's an important consideration. As I alluded to, blunt top-down measures like thinking about sector diversification, diversification by geography, we don't ignore those, but when we're thinking about diversification in our portfolios, we're also very focused on the underlying factors which drive performance and risk within infrastructure assets. Very simple example, say you had an airport here in Australia, a toll road in Europe, and an energy pipeline in the US. On the face of it, you've got three sectors, you've got three geographies, but something like oil prices is probably going to impact the performance of each of them. So, as I say, while we don't sort of ignore those top-down factors, we are very focused on thinking about what those underlying factors are that will influence the actual performance of individual assets and then how they come together in a portfolio.
Thank you. And Tim, just coming to you around some of the common risks that apply to infrastructure assets, how would you define them?
Yeah, certainly. I mean, one thing that hasn't been talked a little bit about is certainly the debt levels. Now, most of these companies, given the more consistent nature of their cash flows, tend to carry much higher debt levels than other comparable companies, certainly in the listed sphere, and you can make those comparisons pretty easily looking at various indices and whatnot. So, you do have to be conscious of that. From that perspective, you've got regulatory risk, which obviously sort of John touched on some of the issues around that in his opening comments as well. And then I think the bigger thing from a portfolio construction perspective is we talk about somewhat correlated, lower correlated, uncorrelated, but as we all know, correlations aren't stable through time. And so being aware of that and being what's going to drive some of the changes in that is important to understand when you're building an overall portfolio. So as it's been touched on, listed infrastructure has held up really well this year in the downturn against broader equity markets. That hasn't necessarily always been true in other drawdowns going back in time, and so those correlations can and do vary. So you need to sort of be conscious of that when putting a portfolio together.
So the debt and the correlations are the two key ones that you think about.
Yeah, for sure.
Yeah. All right. While you're on ESG, so infrastructure. When you think of infrastructure, you don't think ESG and environmentally friendly. That's for sure, but that may be misleading. What's your view on that?
Yeah, well, it's still a pretty early area. I mean, most fund managers are talking about it, how they incorporate it into their capabilities in different ways, shapes and forms. I think the reality for most of us building fund-to-fund portfolios is that real assets as a sector, so this applies equally to property and infrastructure, there's limited building blocks for us to play with, would be what I'd say. So someone who runs our ESG portfolios, obviously there's tons of equity ESG funds now to work through. There's an increasing number of bond ones. Real assets is certainly an area where we're certainly seeing more of the discussion at this point around incorporation of ESG into existing processes rather than I would say more dedicated ESG sustainable ESG or sustainable portfolios. So starting to see more of that emerge. John obviously touched on some of the renewable energy sector, and that's certainly, we expect to see more and more things themed around that in years to come. But building a fund-to-fund portfolio with and wanting to put a specific ESG lens on it, it is still a bit of a challenge in this sector.
Yeah. And there's that the PPP side of it, which typically is a positive ESG kind of strategy as well.
Yeah, sure.
So Trent, just around inflationary concerns, we heard a lot about inflation this morning, and John mentioned in his presentation that infrastructure is a really good, well positioned to deal with inflation. What's your view on that? How does it actually do that?
Look, and again, John did touch on this. If you step back, what are these companies doing? They're providing essential services to society. So when you wake up in the morning, you have your shower, they're providing the water, they're providing the electricity, you drive on the road, you get a plane. These are the essential services that we use each and every day. A simple way to think about it is that when prices go up, they, either through the regulation that they have or often the concession agreement, the contract that's in place, it explicitly allows them to pass that through to the end customer, i.e. yourselves. So we estimate about 70% of our universe, inflation is a direct pass-through. And for our portfolio, we've been positioning even more. It's probably close to around 80-85%. Now, it is going to be more challenging. Clearly, what's playing out in Europe, and as we're seeing, in the UK right now, people's electricity bills are going to be going up 500% in 12 months. Massive, massive numbers. That's when it probably comes back to what the other risk I would talk about, which is political risk. That's for us probably the number one thing you've got to think about when investing in an infrastructure company. So any utility that's maybe going into a rate review cycle, which usually happens every 5 years, you're probably going to be feeling the pressure right now. So that's definitely something to be thinking about. But as a general rule, that ability to pass through to the end customer is there. And it's been proven time and time again over time. And it's, I think, one of the reasons why it's held up and performed well this year.
Thank you. And probably just making sure that you look through the strategy and the assets to make sure that those kind of arrangements are in place. Yeah.
So can I actually just follow up on that, specifically on the political risk, where generally in the OECD countries you can count on the regulatory and legal framework to support you. But could you touch maybe on specifically ideas in the UK, say, about mooting like a windfall tax on excess profits?
Yeah, so I don't know if everyone's familiar, but right now in Europe, one of the key things that's been talked about with utilities is these windfall taxes. So a lot of utilities, particularly if you're a generator, you're making massive, massive returns because prices for gas and everything have gone through the roof. And that gain that you're making to your earnings, there's talk that maybe we should be taxing that at a higher rate, and that's the windfall tax that you're referring to. Look, it's very topical right now. It's not clear where each country is going to end up. I think, as a general rule, the preference is for Europe to try to come together and provide a solution from a top-down perspective, but it's getting more and more difficult. You know, Germany, half of their gas comes from Russia right now. They're scrambling to meet their needs for the winter. So it's definitely something to be aware of. We're talking about extra or super profits for these utilities, so the underlying earnings are still there. But yes, is there a risk that some of those extra profits get pulled back? Absolutely, and arguably they should be as well.
Thank you. Anything to add, John?
No, I think that was a very good synopsis of the situation.
Good. All right, then I'll just in this conversation over here, and again in the presentation, I think, Trent, you referred to it as a defensive equity. I know I was talking to some consultants where they were trimming the asset allocation, the growth part, and there was an infrastructure there that they took out because they saw it as growth. So, you know, what is your view? And I'll start maybe with you, Tim. Is it a defensive asset? Is it a growth asset? How do you see it?
Yeah, if the choice is growth or defensive, it's absolutely a growth asset. We're talking about investing in the equity of the companies that are, running these assets, be it property or infrastructure. So from that perspective, in our view, it's unequivocally a growth asset. There is certainly a debate out there, and certainly many of the super funds get into this of, calling it half-half, and because most of what they hold is unlisted and whatnot. But I think, particularly if you're dealing in a listed-only environment, as most of us in this room are, it's unequivocally a growth asset.
I'd agree with Tim on that one. So from our point of view, you are dealing with a listed structure here. You are in the equity tranche, so we consider real assets at that top growth defensive level. We would absolutely consider it to be a growth asset, noting that you do expect it to behave differently over time from your dedicated equity allocation. For us, that doesn't change the fact that it is a growth asset.
Different view, Trent?
I'll maybe balance it out and maybe take a view that I do see it playing a role of both. Of course, in the short term, you can get volatility in equity markets, but I think as the market becomes more and more educated on the role infrastructure can play, they look through that short-term noise and recognise that actually the earnings of these companies aren't going to change. So I'd probably take a view that it can absolutely, there's a growth driver there behind it. But in terms of the resilience of the earnings and therefore the stability of the cash flows, it can also play a defensive role, recognising that we are in listed markets as well.
Yeah, because I've also heard the term bond proxy. It's is that sort of fits into it. It depends on the type of strategy you've got and the nature of it. So yeah, just because it says bond proxy doesn't mean it's defensive.
Well, I think that the bond proxy argument can be overdone in infrastructure. Yes, there are long-dated cash flows, and those will be sensitive to interest rates. But look at what happened to growth equities this year. Nobody necessarily thought of those as bond proxies per se, but it's undoubtable that they were hit by interest rates re-rating. So I think that applies to more than just infrastructure assets.
Great. So Chris, in terms of performance, as an asset class, infrastructure and infrastructure equity, as an asset class in big market sell downs, how does infrastructure equity perform relative to equities in general?
So we would hope for, in the general course of things, for the drawdown to be less steep than the equity market. Is basically what we'd hope for. So we'd count on over the very long term, noting Tim's point that correlations do change through time, and in real stress environments, they tend to become more correlated. But what we sort of hope for from infrastructure as an asset class over the long term is correlation of 0.6 to 0.7 and a less steep drawdown than listed equity markets experience. Now, that doesn't always work out. Sometimes it works very well, as in this one. So that's a broad generalization, but that's sort of the role we want it to play. And then potentially a longer path to recovery, so a more shallow drawdown, but a more extended one than you might get from listed equities that's at a high level, but that's sort of what you want it to be doing over time from my point of view as someone building a multi-manager portfolio.
So a good diversifier then.
Can be, yes.
Can be.
Yes.
All right, so that sort of wraps up. We were just doing the session around infrastructure as an asset class. The next step is about how do you actually work with it in a portfolio with your clients. So, the first question is, as we all know, that the institutional investors, have large allocations to real assets, be they, property or infrastructure. From our perspective, from a retail client point of view, and Chris, I'll come back to you on this one. What do you think is the appropriate allocation in a retail client's portfolio?
I think it's highly dependent on the client. I think a lot of it comes back down to what an investor is trying to achieve by allocating to infrastructure within the portfolio. Some people will be very comfortable just with the profile of a classic bond and equity portfolio. But if you're going to introduce real assets because you are looking for a little bit of diversification from the traditional equity risk premia, you're looking for a different source of returns and moderate diversification benefits. Lower than the superannuation funds, certainly, because we generally don't have access to unlisted structures, and there are differences between the behavior of those two asset classes. Listed is not a perfect proxy. So we, as a rule of thumb, we tend to see people land between 5 and 15%, let's say, but it is highly dependent on what we want that client's overall portfolio to be achieving, and secondly, what we want the infrastructure asset class by itself to be achieving within that portfolio.
Great. Tim, your thoughts on that?
Yeah, we probably end up with a similar range, and if I look across the spectrum of real assets, it sort of does vary a bit. So if you think about infrastructure to begin with, we'd see that playing more of a core role, particularly for clients at or around retirement, because given those sort of lower drawdown characteristics, that obviously can play an important role in being one component of managing sequencing risk through a growth allocation for clients in that scenario. People with more higher growth-seeking aspirations would probably be where we would add more property, because we see property as being more cyclical, certainly higher vol, and having higher growth targets on that. So if I think about, from, people, depending on the client scenario, more conservative end, more, sensitive to drawing, people in drawdown in particular, that's probably the key component. Infrastructure playing more of a role. Those that are probably maybe more in accumulation, longer term, might have more of a property bent to that, given the high growth features of that.
So sort of the transition to retirement, in retirement is where it plays more of a role than real estate or property?
Yeah, for sure.
Yeah. So you mentioned property over there, and Chris, I know in our conversations we've spoken about the real assets, and you have one bucket, and so explain why, from your point of view, how you view the real assets as a bucket rather than separating infrastructure from property.
Yeah, so we do underneath the hood, I'd say. So at a high level, we group them together, but we do manage subsector allocation as well, although saying that the policy position is generally neutral between the two. So if you look at most of our portfolios and look at target weightings underneath the hood, it's just 50-50 property infrastructure. We don't have a strong view either way as to whether one's going to perform relatively better than any other over a short-term time horizon. So we generally keep it fairly neutral. So we do, I guess moving up the grouping stack, we consider it a separate asset class, but we do consider both separately when we're getting down to the detail of portfolio construction.
Yeah, excellent. And then again, Tim, for you and Chris both, as a portfolio constructor, what are the things that you consider when you thinking about adding infrastructure into your portfolios? What are the things that go through your mind? We've touched on some of it at the start, but maybe just to wrap this up.
Yeah, I mean, recapping some of the things we've talked about, obviously what we think the defensiveness of it can be within a growth allocation, particularly on the infrastructure side. I mean, part of the art as much as the science around that then comes down to which individual funds, strategies are you looking to deploy, because you look at a dozen different listed infrastructure funds that are investable. There can be quite different approaches. Some are much more defensive, some are much more cyclical and growth seeking. So combining the underlying fund investment that you're considering into that framework becomes important too. And so whether that's restricted by your APL, your platform investment menu, whatnot, I think being able to tie the top down and bottom up is important in making that consideration. But from the other top-down issues, I think we've
Touched on.
Yeah.
And Chris, from your point of view, what's the biggest implementation issue you've encountered?
Implementation issue is probably that, given we're building, generally what we're doing is building portfolios in a retail setting, which means we are largely, the opportunity set is confined to Australian domiciled daily or monthly at the most liquid funds. So there is a certain element of your universe becomes narrower because you have, one, you don't really have access to unlisted assets. You can take a look at doing that through some funds that offer sort of a blend underneath the hood, but that's the biggest implementation challenge is the availability of suitable funds for retail portfolio structures, where you are just fundamentally playing a different game than what the superannuation funds are doing because of the structures you can access.
And we've referenced the superannuation funds a fair bit. Any particular reason? Is it just, do we try and compare and compete against them? Is that why they come to mind?
I think for me it's just that the two asset classes, so listed and unlisted, I mentioned this before, but listed can act as a good proxy for unlisted, but it's not the same thing. Unlisted assets will have lower volatility, different return profile, and play a different role in the portfolio. So there's a place for them. But in a retail setting, you're talking about unlisted structures that are potentially closed-ended funds. They have liquidity events every 5 or 7 years. It's just unsuitable. So I think it's just understanding when you allocate to the universe that is available to you in this space, you are playing a different game, I think, because the comparison with superannuation funds does come up. But your opportunity set in listed markets means that you will fundamentally be more volatile. You can still achieve a similar return target over time, but it's understanding that the path to get there is going to look different.
Correct. And it's about...
Yeah, so that's the key point. I mean, it's undoubtedly relevant, right? Because end clients are going to ask you about it. They read about, Host Plus balanced funds did, positive return last financial year when everything else was negative, including probably the portfolio that you've put together for said client. So really understanding the differences that, so it is a different game, it is a different path to get there. We could do a whole different topic on the subject of unlisted asset valuations, but we're not going to touch that one now. But
you're very passionate about that one.
Well, it's super important, right?
Yeah.
But I think all of us know that in a retail setting, I think it is a different game, and that's being able to have an open conversation with clients and understand and communicate and explain that so that they understand the differences is really crucial.
Correct. I mean, you can only build with what is available and suitable for a particular client's need and portfolio. So yeah, you can look at it, but it's like me trying to buy a Ferrari. It's never going to work. I mean, so unless John gives me a big increase. All right. So right, over to you, John. No. In terms of just coming to the back end, and we've got about 10 minutes after this for questions, which hopefully there's a lot of questions because it's a very interesting asset class. From an ordinary retail investor, the infrastructure companies on the ASX, there aren't many of them, and they're getting fewer and fewer. Example, Sydney Airport. So if you're a retail investor, maybe John, if you're a retail investor, how do you replace that dividend stream that you would get from an infrastructure company typically on the ASX?
Yeah, sure. I mean, you're quite right, Marius. Over the years, the number of listed infrastructure companies on the ASX has dwindled considerably. There's only a very small handful left. That said, even in sort of days past when there were a lot more, it was still a relatively confined universe. And so, if you're looking to implement a well-diversified infrastructure portfolio, you really do need to invest globally, and that's the case now more than ever. So if I'm a retail investor, what are my options? I guess I could invest in directly in global listed infrastructure stocks. It tends to be quite time-consuming and challenging, or there are a lot of good listed infrastructure vehicles out there that provide good diversification across global markets.
Trent, anything?
I think John summed it up. I think even before Sydney Airport, Spark, AusNet, all these Australian infrastructure companies were taken private, it only made up 5, 7, 8% of our portfolio. So if you want to invest in this asset class, you really do need to think global. The US is about over half of our portfolio, but the US is almost like 50 countries. Every state has its own utility, often multiples of utilities. There's a huge opportunity there, and I'll just encourage you, if you are thinking about putting money, think beyond these markets.
Thank you. John, you mentioned the Ukraine-Russia war earlier in your talk. Other than the inflationary impacts, what other knock-on effects are there on infrastructure assets?
Oh, I mean, how long have we got? But I think for me, one of the obvious ones is obviously huge increases in energy prices. And so think about a range of infrastructure assets that is going to have an impact. So airports, there's different impacts that you'll see. First of all, airports, use a lot of energy in conducting their operations. And so, that's an increased direct cost to airports as a consequence. A number of airports are taking steps like trying to lock in future energy prices or look to alternative sources like, a number of airports have been commissioning solar farms to provide some of their energy requirements. And then there's also an impact that flows through in terms of, which is a second tier impact, I guess, which is the impact on patronage or passenger movements. At the end of the day, you're seeing a situation at the moment where a lot of airlines around the world have an increased fuel bill due to energy prices. What you're also seeing on some routes, is because of the conflict, is a lot of flights are actually having to take routes that are not optimum routes in order to avoid the conflict zone. And so that also adds to fuel bills. And so airlines take the first hit on that, but as we all know, they're very quick to pass that on to their customers. And we've seen that. And so, the extent to which that has an impact on passenger numbers will ultimately flow through and impact airports, given they charge on a per passenger basis. I think what we've seen so far is that capacity is still very much in a recovery mode from the pandemic. And there's a lot of latent demand for travel. So we have actually seen, despite the fact airfares have been very, very expensive, a high propensity for people to travel and essentially suck up those high airfares. But, with inflation continuing to be high over time, is that going to continue to be the case, or will we see an impact on passenger movements?
Okay. And so Trent, just looking at the opportunities and the themes that are driving the opportunities in the infrastructure space, how would you, from where we are today looking forward, how would you, sort of call them out?
Well, John touched on it as well, but I think if you're thinking growth, as I say, think structural growth, and what are those key thematics? Well, the biggest one that's going to play out over the next 10, 20, 30 years is going to be decarbonisation. So even if I use an example, electric vehicles, if you want to invest in electric vehicles today, you can buy the car manufacturers, you can buy a Tesla, you could buy a mineral company, you could buy maybe even a battery charging company. But another way to think about it is maybe investing in the infrastructure that's going to be needed to build all this. In Australia today, we only have about 2% of new car sales are electric vehicles. Globally, that's at 9%. In parts of Europe, it's at over 20%. And what's been the biggest prohibitor? It's the infrastructure that's needed behind it. So when investing in that thematic, you can, as I say, invest in those car manufacturers, or you can invest in the utility that's going to go spend billions and billions of dollars of CapEx, put it back into its rate base in the best countries, and then earn a regulated return on that CapEx going forward. So it's just a different way of investing. It's, in our view, lower risk, potentially lower return, but that steady, stable return of, call it a 4% dividend yield, 6-8% earnings growth each year now from utilities, we think is going to be very attractive going forward.
Thank you. And then just the last question for Tim and also for Chris. What do you like most about infrastructure? Tim?
I think at the moment, unquestionably, the defensive characteristic of that is definitely, played its role in the most recent drawdown period, the last 6 to 12 months, and that's obviously kept clients happy and met expectations. So continuing to become comfortable that characteristic will be maintained, I think, is probably the most important thing we're continuing to think about.
Thank you. Chris?
I'd agree. That's exactly what I was going to say, Tim. There's nothing I like more as doing portfolio construction, multi-manager, multi-assets, multi-sector, when one of those sectors plays the role you thought it was going to, particularly in a down market, and the asset class that you hoped would experience less of a drawdown actually experienced less of a drawdown. You banked the correlation benefits when you needed to. As Trent alluded to earlier, it actually delivered a positive return, which is just an excellent outcome for investors in infrastructure over the last 6 to 8 months. So, when things work, that's always very pleasing.
Thank you very much. So we'll open it up to questions from the floor.
Hi, Chris made the comment about the effect of interest rate rises on equities, and it was I think I've seen some studies that showed that it was exaggerated in equities just because of the exaggerated prices, I suppose, the multiples and stuff. So obviously, so I accept that equities also have this correlation to interest rates. Obviously, infrastructure does. How about property? I mean, property seems to me that it's got two risks. It's got the fact that the kind of returns that are expected out of property obviously reduced, and now that interest rates are going up, you've got the return that's got to be reflected in the pricing. To what extent has the inflation of property values to what extent is that going to be reflected in property returns over the next few years?
Maybe I'll comment on the piece about to what extent are valuations affected by interest rates, just more broadly, and then I'm happy to pass to you guys if you have a more nuanced or deeper view on where you expect the return level to be based on that. But it is a good point. I think the way we think about building return assumptions going forward or valuations across the board is that interest rates matter to all of those things. So fundamentally, we think of returns as being a building block approach where you get compensated for whatever the current risk-free rate is plus different premia on top of that. So any re-rating in interest rates impacts all asset classes in our view. And then in terms of that exaggeration effect, I think that's probably right as well. I mean, given how far, for example, very long-dated tech stocks have fallen off. Part of that is just the fact that DCF models display convexity, which just means that interest rate changes between 0 and 1 are more powerful for valuations than rate changes between 3 and 4, say. So part of what you've seen is just the convexity of interest rates working against you for the first time in 40 years. So it perhaps has been a bit exaggerated, and also there will be factors like market sentiment that have really blown that magnitude out very quickly. But more broadly, we think that, yes, the changes in interest rates, when interest rates go up and cash rates come up, that puts pressure on valuations across the board. Now, where that leaves your ex-ante return expectations is also, you would argue, higher because rates are starting at a different base. But maybe I'll pass to you guys on the expectations looking forward.
Noting that you're not property experts.
Yeah. I'll make one comment, and obviously we're not property experts, but I think you also need to think about what's the reason why rates are going up. And it appears clear all over the world that governments are increasing interest rates because inflation has got out of control. So therefore the question to ask is, how much confidence do you have that you can pass that higher interest rate costs through to the end customer, whether this is property, infrastructure, frankly any company? What's your pricing power? And it comes back to that ability, that inflation protection in the case of infrastructure. We've got a high degree of confidence that in the majority of cases it will get passed through to the end customer. And then you've got to also look at, of course, how much leverage is on the balance sheet. Have they fixed that debt? And again, for a lot of these companies now, our top 10 holdings, the average debt maturity is about 13 years. So they've learnt the lessons of the global financial crisis. They've locked in that debt at very, very low rates. So there's almost an argument that there's a jaws opening up where your revenues are going up, but your interest costs have been fixed. But the other side is obviously valuations and the discount rate, and it's there's lots of moving parts there.
Just picking up on the property issue, though, I think particularly if you're dealing and looking in listed markets, though, the thing with most both domestic and global property, you'll see it's not just bricks and mortar assets. You're looking at funds management businesses. You're looking at retail assets that are exposed to the consumer, which obviously has a fairly negative outlook at the moment, and so there's a lot more cyclicality built into listed property markets. So hence my earlier comments about why we see listed property more only at the sort of higher risk, higher return seeking end of client portfolios and not making up a portion of real asset exposure for what we think of as core balanced client approach where infrastructure is more important because we think it does have more defensive characteristics. Even though historically 10, 15 years ago you might have thought of property in that way. There's a lot more cyclicality in those markets now.
Just noting, we're almost out of time here, but just picking up on that, we didn't even touch on this, but Tim's comments there around what makes up the listed property and listed infrastructure universe. To us, you do want to be avoiding things like real estate operating companies, very highly leveraged companies, things that are actually fund managers or in some cases even family offices. And on the infrastructure side, you want to avoid, for most people, moving outside of core markets or moving into greenfield development, say, which to us argues for active management to help you manage those risks and make sure that listed exposure is an actual proxy for the underlying, which is an interesting discussion to have in and of itself. But I think the clock is flashing at me.
Over. So do you want to go for another question? Another?
Question maybe for Trent or John. What are the challenges of putting together a listed infrastructure portfolio in managed accounts specifically, as opposed to a fund?
Do you want to take that? It's probably more your area.
What are the challenges for putting together? Look, if you're a superannuation fund, clearly you have, in the majority of cases, very, very deep pockets. So you might have billions of dollars or hundreds of millions of dollars to invest in the asset class. So you can take very large stakes in these companies. And my background was on the private side. We would often take 30, 40, even 100% ownership stakes in these companies. I imagine the majority of you here today, your clients don't have that kind of capital. Therefore, they're looking to invest in something that's perhaps more liquid. And that's where listed infrastructure can play an important role. So investing with, you can either invest in the direct equity, buying a Transurban in listed markets, and you can put your clients into that, or perhaps looking at a managed fund, like a unit trust vehicle, which is a global fund that there's a number of them in the market today that can provide that solution to you. So it's just a difference in the super funds have got very long dated perspectives. They've got very deep pockets, and they are making meaningful investments in these assets. For me, that actually gives me comfort as an investor in listed infrastructure assets. We talked a lot about downside protection, and we've seen this time and time again in this market. If the price of our securities falls enough, there's over $300 billion of capital sitting right now waiting to invest. They can wait for governments to privatise these assets, or they can look at listed markets to ultimately take them private. So I think, if anything, that provides you with another element of downside protection.
I just want to check, is the point behind your question just the liquidity side of it, the daily pricing and things like that? Was that where you were getting at? When the mic comes back. I know you're going to kick us off in a moment.
It's actually related to constructing a listed infrastructure portfolio in a managed account rather than having it as a unit trust, fund.
You're talking about buying the stocks directly as opposed to buying fund managers, unit trusts. Is that what you're
putting
talking
the portfolio on a platform?
Yeah. All right. Well, I mean, your concentration or the ability to get diversification depending on how much money you got, I think first and foremost is going to be an issue, as we've already sort of touched on, particularly if you're only dealing on the ASX. Like, that's a big issue and one of the reasons why we generally only go global anyway. I don't know if you've got anything else.
I don't have much to add there. We tend to look for global exposures in property and infrastructure just because the opportunity set outside of Australia is so much broader. So we would advocate for 99% of people, we use managed funds with global underlying portfolios rather than direct.
Great. We're well over time. Okay, so thank you very much to the panelists. Over to you, Vin.
Thank you, gents. Marius, Chris, Tim, Trent, John, really appreciate those insights into property and infrastructure.